You know, for decades, there's been this simple economic rule. When inflation gets too hot, central banks raise interest rates, and the economy cools right down. It's been the go-to playbook, the one thing we could always count on. But what happens when the playbook just stops working?
And that is the huge puzzle we're all facing right now. Central banks all over the world have thrown everything they have at this problem. I mean, we're talking about the fastest, most aggressive rate hikes in a generation. And yet, inflation has been incredibly stubborn.
So what you've got is this massive gap between what we expected and what's actually happening. The old, reliable formula on the left just isn't delivering. It's being challenged by this new, really frustrating reality on the right. In this explainer, we're going to break down exactly why.
Okay, so let's dive right in. The first piece of this story isn't about a lack of effort. Far from it. It's about the tools themselves. It really seems like the levers that central banks have been pulling just don't have the same kind of power they used to.
And believe me, the effort has been absolutely monumental. Just look at the scale of these hikes. In the US, the Federal Reserve took rates from basically zero all the way up to over 5%. The European Central Bank literally yanked its rates out of negative territory and pushed them to 4.5%. This was a coordinated global shock treatment.
But here's the kicker. Recent analysis, once you correct for some long-standing biases in the research, tells us something pretty startling. A full 1% interest rate hike, now it only reduces prices by less than 0.25%. The tool that we all thought was a sledgehammer is, well, it's turning out to be a lot less powerful. And you can see the fallout right here. When your tools aren't working as expected, your forecasts can go way off. Central banks missed the 2022 inflation peak by a country mile. The Fed, for example, predicted 2.7%. The actual number was 9.1%. These kinds of misses, they really damage public trust, which, in a strange way, makes their policies even less effective. It's a tough cycle.
Okay, so that brings us to the second huge piece of the puzzle. Because you see, the problem isn't just that the old tools are weaker. The whole economic game has changed. For years, fighting inflation was mostly about managing how much people were spending. Now, it's a whole different story.
This number right here is so important. Research estimates that a staggering 60% of the recent inflation spike came from supply-side disruptions. Think about that. This wasn't a classic case of too much money chasing too few goods. It was a case of the goods just not being there. And let's be clear, you can't fix a broken supply chain by raising interest rates.
For decades, the global economy ran on this beautiful, hyper-efficient idea called just-in-time. It was all about keeping costs super low by having parts and products show up exactly when they were needed, with almost no inventory sitting around.
But the pandemic and all the geopolitical shocks just shattered that system. So now, the philosophy has completely flipped to just in case. Companies want resilience, they're building backup supply chains, they're holding more stuff in warehouses. Now this makes the system safer for sure, but it also structurally and permanently raises costs for all of us.
And there's another brand new supply-side force we have to talk about, greenflation. This isn't some temporary blip. It's the long-term price pressure that's being created by the massive, and I mean massive investment needed to shift our entire energy system.
And to really see what this means, just look at what goes into a single battery for an electric car. It's an incredible mix of lithium, cobalt, nickel, and a bunch of other critical minerals. The demand for these materials is just exploding, but the supply, well, it's really tight, limited by long mining lead times and politics. That is a recipe for structurally higher prices for a long, long time.
All right, so to really get what's happening now, you have to understand that inflation isn't one single thing anymore. We're seeing this major split in how different prices are acting. It's like inflation has developed two completely different personalities.
On one side, you've got inflation for goods. Things like TVs, furniture, cars. These prices are set on the global market. And as all those supply chains have healed, their prices have actually started coming down. But then on the other side, you have services inflation. Things like haircuts, going out to eat, and especially rent. These are local, they're driven by wages, and they have stayed stubbornly high.
And this right here is the absolute heart of the problem today. Core services inflation has just defied everyone's expectations. It's stuck way above where it was before the pandemic, and that stickiness is the #1 reason central banks are still struggling to get back to their targets.
So what's the biggest culprit behind that sticky services inflation? Well, in the US, it's this right here, shelter. Housing costs make up over a third of the main inflation index. It's so big, in fact, that if you took it out, core inflation would already be pretty darn close to the Fed's target.
And here's the weird thing about housing. The official inflation numbers measure rent with a really long delay. So the high inflation we're seeing today is partly just an echo of those huge rent spikes from a year or two ago. It's a mechanical thing in the data that interest rates can't really do anything about. We just kind of have to wait for the numbers to catch up.
So when you pull all these threads together, weaker tools, new supply problems, that sticky services inflation, it all points to a really profound conclusion. We aren't just in some tough economic cycle. We are entering a fundamentally new economic era. You see, the last 30 years were kind of an anomaly. We lived in this world with powerful forces that were constantly pushing inflation down. Things like globalization, cheap energy, a growing global workforce, they all helped keep prices low. Now, pretty much every single one of those forces is going into reverse.
And these are the new structural forces that we have to deal with. We're moving from a globalized world to one with more tariffs. The energy transition is adding costs. Aging populations mean fewer workers, which pushes wages up. And like we said, businesses are choosing safety over just being cheap, and central banks have, frankly, lost some of their inflation-fighting street cred.
So what's the biggest risk in this new era? It's a scenario that some people are starting to call stagflation light. Now, it's not the full-blown crisis of the 1970s, but it's this really frustrating environment where the economy doesn't grow very fast, but inflation just refuses to go back down to that 2% target. It's really the worst of both worlds.
If you remember just one thing from all of this, let it be this shift in momentum. For 3 decades, the global economy had these powerful tailwinds at its back, pushing inflation down. Now, we've turned a corner, and we're running straight into structural headwinds that are actively pushing it up.
Which leaves all of us with the ultimate question. The world has fundamentally changed. The challenges we're facing are new, and they're different, so we have to ask, is the old playbook, the one that relies almost entirely on central banks and interest rates, is it still the right one for the job ahead?